Okay, so let's continue with the story. So what happens after? Like I told you in our previous meeting, she's still gonna have a car payment because now she's the bank. So just because she's the bank, it doesn't mean the car payment is gonna go away. So these $11,000 a year, about 900 and something dollars a month, now that's gonna be her car payment, and she's gonna be doing that for the next 5 years. Let's say it's a 60-month loan, right? And what happens after 5 years? She's gonna sell that old car and she's gonna buy a new one. And that's this 47,000 coming out again. Now she needs to replace that car. But look at what happens at that point. At that point, she's earning interest and dividends on $170,000. So my question to you is, when was the last time you bought something and your balance actually went up? If that hasn't happened before, it's because you're not being your own bank. You're relying on other people and you're financing it that way. But that's not a very smart way, because look at what happens. You're giving up all that opportunity cost. If she wants to just pay for the car in cash, or even worse, if she was to go and finance it, she wouldn't have an account right now worth 170,000, let alone a debt benefit worth 1,478,000, right? All that will be gone. So can you see now how $1 is doing multiple things? Is buying the car, is providing financing, is closing opportunity costs, and also providing a debt benefit for her heirs if something wants to happen to her? $1 doing multiple things, just like banks do. So we're going to repeat this effort or these purchases every 5 years, all the way until she retires. We're going to do this 9 times. So let's fast forward to age 74. Here you can see she got her last car at age 74. When she turns age 78, she says, Janko, I'm done. I don't need any more vehicles. I can barely drive anymore. So I'm fine. We're not going to buy any more cars. So what happens? Well, before I show you the number, I want you to imagine this. If she would have bought these 9 cars the traditional way, just getting a loan, turning in the old car, getting a new loan, if you have any negative equity, rolling into the new loan, and so on and so on. If she was to do the same thing that everybody does, how much money she would have ended up with? Well, she would have ended with zero, right? Because it was all well transferred, zero and a 5-year-old car. That's what have been the end result. But because she took control of her financial life and she decided to become her own bank, now she's making interest on an account worth $1,940,000. So we went from zero to almost 2 million. So when you think about it, well, if I just buy 9 cars at $47,000 each, that's $423,000, right? So where do you get 2 millions from? Opportunity cost. It's not just the money that you're paying, it's also the interest you're not making all throughout those 52 years, compounded every year. And in this scenario, actually tax free. That's how much money you are leaving on the table when you finance it. Your things, your car, your motorcycle, your home, whatever, just through straight income payments. That's how much money you're leaving on the table. Look at her net cash value. It's almost 1.2 million. And her gross debt benefit is almost 2.8 million. So at this point, the clients usually ask, well, Janko, this is awesome, but this can't be for free. What is the catch? Well, of course, it's not free. We're borrowing from the insurance company. So you see loan balance, we owe the insurance company almost $800,000. Do I care? No, because it's going to be deducted from my debt benefit when I die. And that's when if the client dies right there, her family only gets almost 2 million instead of 2.8 million. It's still kind of nice, isn't it? Still better than zero, but it is true, there is a cost. But the cost can be managed. It's about leverage, just like your mortgage. Do you care paying the bank 3-4% interest when you're making 10, 12, 13? No, you don't care. It's exactly the same thing. We're leveraging on another financial asset, which is her income or economic output, economic capacity. Okay, let's finish this up. Now she's sending in over $1 million, so let's pay her $50,000 a year of cash flow, tax-free cash flow after age 78, right? This is not a retirement account, but we do have $1 million, so let's give that money to her. So we're gonna pay $50,000 a year all the way to age 93. Why age 93? No reason. It just fit on my page. That's all it is. This could keep going all the way to age 100, 120, right? So what happens at age 93? Let's say she piles away at age 93. Look at her gross cash value. She's still earning interest on almost 3.5 million. She still have $831,000 liquid. And look at that debt benefit, 1,135,000. All that came from her car payments. $400,000, $84,000 that she put in to capitalize the account. She borrow, pay back, borrow, pay back. She leveraged on that over time, and that ended up generating north of $4 million of wealth. So let's summarize this for all of you guys. So how much did she put into her account? 84,000. That's the amount that she capitalized her account with. From that point on, she took money out, put it back with interest. Took money out, put it back with interest. So she took $423,000 to buy cars, and that created wealth with the cash value and the benefit equal to over $4.5 million. That will be a tax equivalent number of $6.5 million if that money was to be in a taxable account. That's kind of crazy. All just from the car payments. So our goal here for you guys is to understand how expensive financing is. All of us are worried about retirement and rates of return and the value of Bitcoin, and we completely ignore the cost of financing the things that we need to buy every day. What I'm trying to tell you is, yes, those things are important, but if you also focus on the cost of the things that you finance every single day, you can build more wealth on a safely semi-guaranteed way that can help you also do those other investments and other things that you want to do as well. And to wrap this point up, this is just one car. What about if she talked to her husband and now they finance the two cars? What about if they finance the husband's car and the children's vehicles? What about if they finance their college education through this as well? Do you see what starts to happen? The more quote unquote loans they have, the better it's going to look in the end, provided they pay themselves back with interest. We took a liability and we turn it into an economic asset, just like banks do. Does that make sense, Charity?
Sounds great to me. Now I've got a question for you. What if I already have a house and I want to take the equity out of my house? Could I do the same thing with that?
Well, the short answer is no, because you have no control of that equity. You have to go through a bank and pay that bank interest opportunity cost for the privilege of using your own equity. All right.
Okay, great.
So that's what we advise clients, that you want to have other buckets of money that you control, right? You want to be the person in control. We call it a bank, but what we really mean to say is that you want to be the one in control. We call it luck. You want to have luck, liquidity, use, and control of your money. When the equity is the control of somebody else, yeah, it's nice to have it, but there's going to be a cost for you to use it. And sometimes you cannot even use it. Using the example of the bank, if you walk into a bank and you want to get a home equity line of credit, you can only get approved for that when you don't need it. When you have a great job, you have a great income, you're in great health, when everything is fine. When you actually need the money, when you're unemployed, when you're disabled, when there's an economic downturn, that's exactly when you cannot get it, right? Whereas if you are the bank, quote unquote, then you can control that, and it's a phone call to get to your money. A very, very different relationship, but ultimately the goal is, as you're saying, is leverage on those financial assets that we have that we don't know we have, like your economic potential. You can leverage on that and create another asset that you can build wealth with alongside everything else that the client may own.
Great, thank you. All right, so we will see you again next time. And what are we going to be talking about next time, Junko?
Well, we're gonna probably do a Q&A session about what we just show you. So if you guys have any questions, let us know. Although in addition, we're gonna prepare some questions that most clients have. Let's call it a frequently asked questions, FAQ. So we'll answer that next time. But if you guys would like to learn more, let us know. We can sit down on a one-on-one basis and figure out, does this make sense for you? Can you make this work? So we'll do that on a one-on-one basis.
Sounds great. We'll see you in our next podcast.
Fantastic. Thank you, everybody. Have a great day.